As of 12:51 p.m. Eastern Time, Plug Power, ticker PLUG, is trading at $2.59 per share, down about 2.26% for the day, or a loss of 6 cents. The stock has been volatile, hitting a high of $2.72 and a low of $2.56 so far in the session, all on pretty significant volume of over 52 million shares. Now, the immediate gut reaction for many investors is to see this as just another day of noise for a stock synonymous with the green hydrogen future. The expectation is that you buy Plug, you hold it for a decade, and you wait for the world to catch up. But that expectation is colliding with a much more complex and urgent reality. What the market is actually trading today isn't that 10-year dream. It's the company's desperate need for cash, a brutal political headwind from Washington, and one of the most crowded, high-stakes short trades on the entire NASDAQ. The long-term narrative is a story, but the short-term price action is a fight for survival. And right now, the bears are putting up a very strong argument. The common belief, the one you'll find plastered across forums and social media, is that Plug Power is a first mover in an industry that simply must exist for the world to decarbonize. They build the fuel cells, they are starting to produce the green hydrogen, and governments will have no choice but to support them. This narrative got a huge jolt in early October, when the stock wasn't rallying on hydrogen news, but on whispers about its potential role in powering the massive energy demands of artificial intelligence data centers. It was a new, exciting story. But this is the classic Plug Power cycle. A compelling narrative pulls in new buyers, the stock spikes, and then the fundamental reality of its balance sheet reasserts itself. The challenge to this inevitable success narrative is that the company is burning through cash at an alarming rate. While the announced improvements in 2024, the fourth quarter still posted a staggering gross margin loss of 122%. You don't need to be a Wall Street analyst to know that you cannot lose that much on every sale and make it up in volume. This brings us to the recent stock movement, which has been less about green energy and more about financial engineering. The stock has been struggling to hold its 50-day moving average, which sits around $2.47. The 4% drop we saw yesterday on nearly 80 million shares and today's continued weakness isn't happening in a vacuum. It's the market digesting the company's October 8th capital raise. Plug announced a warrant inducement transaction that raised $370 million in immediate cash. This was absolutely critical, as the company ended 2024 with only about $200 million in unrestricted cash. That $370 million buys them time, but the market read the fine print. In exchange for that cash, the company issued new warrants that, if exercised, could bring in another $1.4 billion. The catch? Those new warrants represent a potential 185.4 million new shares. This is the definition of a double-edged sword. They get the cash they need to avoid a going concern warning, but they do it by creating a massive overhang of potential future dilution that will hang over the stock price for years. Now let's talk about the elephant in the room, which is the short-selling activity. Plug Power is not just a stock, it's a battlefield. According to the most recent data from Fintel and NASDAQ, the short interest is astronomical. We are talking about 331.37 million shares being held short. That translates to 29.59% of the stock's entire free float. To put that in perspective, anything over 20% is considered extremely high. This means nearly 1/3 of the available stock is being used to bet against the company. The days to cover, or the time it would take for all those shorts to buy back their shares based on average volume, is hovering around 3.9 days. That is a significant amount of time, creating a very crowded trade. So, what is the short thesis? It's simple: cash burn and profitability. The bears are betting that Plug cannot reach profitability before it runs out of cash and is forced to dilute shareholders into oblivion or, in a worst-case scenario, face insolvency. They see the negative gross margins, the intense capital expenditure required to build out its hydrogen plants in Georgia and Tennessee, and they see a company that is fundamentally dependent on outside funding. But here is where it gets incredibly interesting for active investors. That 29.59% short float is a keg of gunpowder. While the bears are in control, the cost to maintain those short positions is becoming painful. The latest data from Interactive Brokers shows the annualized borrow fee for Plug shares is sitting at 15.10%. That is an expensive loan. Shorts are paying a hefty premium to bet against this stock, which can sometimes mean that any piece of good news could force them to buy back their shares, igniting a short squeeze. For investors trying to navigate this is where you need to be responsible. You can find this data yourself. You can look at Fintel, Ortex, or even your own broker's platform to see the short interest percentage and the borrow fee. When you see a borrow fee spike from, say, 5% to 15 or 20%, it doesn't automatically mean a squeeze is coming. It means the supply of shares available to borrow is drying up, and the demand to short is high. It's a signal of extreme tension. We also have to look at the failed to deliver data. In late September, there were significant FTDs, with one day, September 24th, seeing nearly 4.8 million shares failed to be delivered. While this can be for many reasons, a pattern of high FTDs can sometimes suggest settlement issues or difficulty in locating shares, which is another data point retail investors watch closely. What's your take on the 29.59% short interest? Is it smart money seeing the cash burn, or is it an over-leveraged position ripe for a squeeze? This entire financial drama is playing out against a new and devastating political backdrop. For over a year, the biggest expectation for Plug bulls was the approval of a massive multi-billion-dollar loan guarantee from the Department of Energy. This loan was seen as the ultimate backstop, the bridge to profitability. However, the political landscape has changed dramatically. Recent announcements from the DOE, under the new administration that took office in 2025, paint a grim picture. On October 2nd, the DOE announced the termination of 223 projects, stating they were, quote, not economically viable and did not, quote, adequately advance the nation's energy needs, end quote. The loan program's website has been updated, and its new focus is on grid reliability and even mentions coal. This is a 180-degree turn from the previous administration's green energy focus. The reality is that the DOE loan Plug Power was counting on is very likely dead in the water. This hasn't been fully priced in, and it fundamentally breaks the bull case for many long-term holders who saw the government as a partner. So what exactly is Plug Power? Stripped of the hype and the short-selling drama, the company has two main parts. Its legacy business, and the one that actually generates most of its revenue, is building hydrogen fuel cell systems for material handling equipment, primarily forklifts for companies like Amazon and Walmart. This is a real business, but it's not the high-growth story investors bought into. The big gamble, the future of hydrogen play, is its new business of becoming a vertically integrated energy company. This involves building massive electrolyzer systems to split water into hydrogen and oxygen, and building the plants to produce the green hydrogen fuel itself. This is where the Georgia, Louisiana, and Tennessee plants are all about. Recent news shows they are trying to expand this into sustainable aviation fuel, SAF, and renewable diesel, as seen in their new partnerships with Allied Biofuels and Edgewood Renewables. This is where all the capital is being spent, and it's the part of the business that is hemorrhaging cash. Looking forward, the outlook is balanced on a knife's edge. The bull case scenario is that the $370 million in new cash gives them enough runway to get their production plants fully scaled. They hope that by scaling up, they can finally achieve positive gross margins on their hydrogen fuel. If they can do this, and if the AI data center narrative gains real traction, the shorts could be forced to cover, leading to a massive rally. The company has proven it can sign big deals, like the 2-gigawatt electrolyzer agreement in Uzbekistan. The technology is not the question, the economics are. The bear case, however, is now much stronger. The reality is that the DOE loan is gone. This means Plug must fund its cash burn entirely through the capital markets, which means more dilution, like the 185.4 million share warrant overhang. Analyst ratings are reflecting this deep divide. Out of 31 analysts, the consensus is a hold with price targets all over the map, from as high as $7.35 to as low as $0.76. Morgan Stanley and BMO Capital remain firmly bearish with underweight and underperform ratings. The mean price target is $2.58, which is right where the stock is trading, suggesting Wall Street has no conviction either way. Comment below if you are holding Plug Power for the hydrogen dream or if you are trading it for the volatility. In summary, the story of Plug Power is the ultimate example of expectation versus reality. The expectation is a clean, green hydrogen-powered future with Plug at the center, backed by government support. The reality is a company with a brilliant product but brutal economics